March is off to a shaky start. They say if it comes in like a lion, it'll go out like a lamb. With a few more weeks until quarter end, we'll see if the recent recovery in equities in the U.S. turns out to be a bear market rally. I'm joined by economist and investment advisor Gary Shilling. Gary, great to have you here today.
Delighted to be with you.
Well, here we are on the 10th anniversary of the bull market. Now, we've seen U.S. equities come a long way, but we are seeing a shaky start to this month, Gary, and I know that we saw that bottom in U.S. equities on December 24th.
Right.
So given all the Fed commentary, their change in tone, do you see recession risks on the horizon?
Yeah, I do. We're rating a recession as a 2/3 probability to start this year, and the other third is simply slower growth. But I think people yelled hallelujah when the Fed basically went on pause, but they didn't really think, why did the Fed do that? And they did that, I think, because they saw, certainly we saw, accumulating evidence that the economy was weakening and there was a recession in prospect, and they're trying to get out of the way of it. So, and I think this is a bear market rally as a result.
And Gary, it's quite remarkable when we look at the gains for the U.S. equity averages for January and February, they've come a long way. And depending on where we end up this quarter, we could see the best start to U.S. equities in nearly 3 decades. But we have to keep in mind that the fundamentals haven't changed all that much, with the exception that the partial government shutdown finally came to an end. So given all those risks, tell me a little bit about the Phillips curve and the change in language coming out from the Fed.
Yeah, well, the Fed, I think they've changed their view. They were run by academic economists, Bernanke and Yellen, and they believe very much in theory. This Phillips curve that says that at lower unemployment rates you should have higher inflation. Well, it hasn't been that way. A number of factors there: globalization, which is probably the biggest economic event on the global scene in the last 30 years, the transfer of high-paid manufacturing jobs from Europe and North America to China and other Asian countries. And you have a lot of other things that are really preventing wages from increasing. Uber, the on-demand economy, the fact that most of the jobs created are low-income jobs. There are things in hospitality, room clerks and so on, retail. There's a lot of reasons that we've identified for this, but the Fed has been very slow to realize that. But now, under the new chairman, Powell, he's not a PhD economist. I am, but I'm not sure you want one running the Fed, at least for a while. And he's much more practical, and I think they really junked the Phillips curve idea and admitted the reality that we are in a very low inflationary era, and we're not going to see big wage increases, which are what you need to push inflation. And I think there's probably more risk of deflation than a return to high inflation in the foreseeable future.
Well, Gary, you are a PhD and economist as well. So if you were in Powell's position, what would you do?
Fade back and punt? No, I think they're probably doing about what they should do. They're not sure that they have increased rates high enough earlier to precipitate a recession. But that's the normal course of things. They may have already done the job. And matter of fact, by my count, in 13 tries to cool off what they saw an overheated economy in the post-war period, they only succeeded once in effecting a soft landing in the mid-1990s. The other 12 times they got a recession. So I think he's probably doing what they should. And there are really 3 scenarios from here. One is that the Fed does pull off the second soft landing in the entire post-war period. I don't think that's a big probability. The second one is that the economy, that this is just a sort of mid-course correction, momentary softness. We're going to see revival, strong growth. The economy continues to expand. And in that case, the Fed would be tightening later. They want higher rates. They worry about speculation. You look at things like Bitcoin, the rush into emerging markets, into private equity, leveraged loans, and so on. They don't like the speculation. Also, they want to have higher rates so they can cut them during the next recession. Now, the third probability is that we already they've done the deed and we have a recession. And you have many things indicating that. The stock market sell-off we saw in the 4th quarter, a weakness in housing, a whole host of things. Globally, economic indicators are slipping. So I think that's probably the third and more likely outcome.
Well, you just highlighted a lot of the data points that we're all watching, as well as fundamentals. You just recently published the March edition of your Insights newsletter, and you went in depth regarding all those points.
Yes.
Now, as an investment advisor, I know that you're saying long US dollar, treasury bonds, short commodities, but we can't have a conversation about potential recessions or recessions in general without talking about gold. So what is your position on gold as well as gold stocks?
I'm really agnostic on gold. There are just too many forces pushing it around, unless one dominates, like inflation did in the 70s, and perhaps a couple of years ago, uncertainty about economic data. But normally, they kind of cancel each other out, and gold doesn't go anywhere. But I'm agnostic on gold.
And moving on, you mentioned politics, and I do want to briefly touch on that. Now, I know that you've gone through different presidential administrations in that you've lived through them as an economist. So you've seen what different economic policies do to the overall economy. And right now we're seeing a rise in populism, not just in the US, but all throughout the world. So how do you grab a handle on what's happening in terms of populism, and what do you think it means for the globe?
Well, I think populism is a direct result of globalization. In other words, you transfer these high-paid jobs, particularly in manufacturing, from Europe and North America to China and other Asian countries. And as a result, there's been virtually no growth in purchasing power for the average person in any of the G7 countries for over a decade. And that's made people mad as hell. And I think that's the result of that is populism. And you see Brexit in the UK, reaction there to immigrants and other things. You see it certainly elected Trump in this country. He blames it on immigration and imports. It's not quite that simple, but we've seen it in Italy, where you've got a rather strange party. Merkel in Germany is really losing control. Macron in France, he's got his yellow vest to deal with. This is a serious phenomenon, and I don't think there's going to be any return to more stable situations until you get more growth in purchasing power, and that's probably some years away.
And you just mentioned Brexit and the EU, so I do want to talk about the risks in the UK as well as in the Eurozone. We're here on the eve of the ECB rate decision, and while no change is expected in terms of rates, a lot of people are wondering what's going to happen with the ECB. They just ended their program a couple months ago, but what do you see on the horizon for the UK and the EU?
Well, in this March edition of our newsletter Insight, I did have an article on the euro, which is now 20 years old, and it's actually about the same where it started in 1999. It's really gone nowhere, despite all the great hopes that it was going to become a rival to the dollar internationally and cause Europe to get together and remove all the inefficiencies and be able to get the economies of scale of the European-wide markets. But there's a lot of problems in there. When they put the Eurozone together, they put together all these disparate countries under one currency, but no common fiscal policy, and they're probably not possible given the vast cultural and economic differences among the countries. And so the Eurozone, this growth is slowing there, and this is a cyclical phenomenon. But I think long term, it was a flawed concept. They wanted to do this because they decided after World War II, the leaders decided, we got to communicate in some other way than we normally do, which is all out war. They decided if they could get their economies sufficiently intertwined, that would reduce the odds, and that was certainly a noble objective, but it really has not worked out that well. And of course, right now with the economy slipping there, the ECB has got this dilemma. They've just decided that they ought to stop their quantitative easing, and they haven't really reversed it, but I would say the odds are they'll probably go back to it, given the softness in the European economy and the political uncertainty there. And I mean, the ECB is really the only organization that operates throughout the Eurozone and has tremendous influence beyond that in the European Union entirely.
Well, we know that the ECB isn't the only central bank in the world that's facing challenges right now. Well, we started out here in the U.S. for a discussion. We went across the Atlantic, and now I want to bring the discussion back home, very local to New York City. I know you wrote a commentary regarding Amazon not coming to Long Island City here in New York City, and we know that between the tax breaks, the union challenges, that it was going to be a very difficult challenge to bring Amazon here. But we know that Jeff Bezos, he's lived and worked in New York City, but he has made it elsewhere. So tell me about your thoughts on this pullout of Amazon from New York.
Well, I was surprised that Amazon considered the New York area to begin with because of the very heavy unionization here and frankly the attitude of New York of, you know, we're the greatest spot in the world and you're lucky if you can join us. And that's what I concentrate on this commentary is really this attitude in New York that they're the center of the universe, and it really is, and they've been able to, you know, they've been able to get away with it. I mean, New York has a financial district here. It has, of course, the theaters. It has museums. Tourists come here, great attractions. You see people sunburning their tonsils. They're looking up the buildings with their mouths open. But I think in Jeff Bezos that New York has met its match because he's the wealthiest man in the world, and he's basically in a position to say, no, we don't need you, and I hope it's a wake-up call for New York, but I doubt it seriously. You know, Governor Cuomo talks about states with cheaper taxes stealing New York residents. Well, people move out. I mean, there's net exodus of a resident population in New York City, New York. I mean, people just saying, hey, it's too expensive and too inconvenient, and you know, maybe this will be a wake-up call. But of course, the governor is trying to attract, to revive this discussion, and New York City mayor here is sort of trying to. I mean, he really tried to cover his tracks. He said, well, you know, they'd be lucky if they come to New York. If you make it here, you make it anywhere, you know. But I think I hope they're realizing that they have finally met their match in Jeff Bezos and Amazon.
And Gary, before I let you go, we know that Amazon has changed the way that a lot of people do business and how consumers purchase their goods. But are there any other trends that you're watching as we head into the rest of 2019?
Well, yeah, I think there are a lot of things that are continuing. Certainly what Amazon is doing to retailing, and I would hate to be anybody, a retailer in any way, competing with Amazon. And now they're moving into the grocery business, and you see what happens. You know, Kroger stocks takes a hit that day. They're an amazing institution. And you know, another thing that is sort of the Uberization, if you will, the on-demand economy where people are willing to work for less money in return for the flexibility of schedules and work when they want to, and so on. What I think is going to be interesting to see is what happens from a regulatory standpoint, because the whole regulatory apparatus is set up to deal with cartels of businesses that make things, you know, steel, cars, whatever. It's not set up to deal with basically a software, an electronic kind of challenges. And you look at what the social media has done and the whole question of invasion of privacy, and you know, I mean, how would Facebook operate if they weren't able to get into the people and have this information? And of course, that's what is valuable out of these companies is the data that they gather that they can sell elsewhere and can be massaged with artificial intelligence and so on. And I think we're probably going to see develop, maybe not this year, but over time, a new look on the regulatory front to deal with this. That would probably be more likely if the Democrats get control of Washington in the 2020 election than it is right now, but it's certainly a growing trend, and not only in the U.S. but in Europe as well.
Well, Gary, the landscape for businesses has changed significantly in the past decade, so who knows what we'll see in the next decade. But thank you so much for joining me, and thank you for sharing all your insights.
My pleasure. I enjoyed it.